Welcome to Inside's Economist's Mind. Why did the RBA hold the cash rate at 3.60%? We dive into the surprisingly strong September inflation data and the new assessment that Australia's economy is tighter than previously thought, delaying the return to the 2–3% target range.
Yeah, it's the classic headache for central banks, isn't it? Just when you think things are cooling off, you get data like this throwing a real curveball.
Exactly, and that narrative that had been building since, August?
Yeah.
That things were decelerating nicely.
It just flipped completely in, just one quarter.
So that's our mission today. We're digging into the November 2025 Statement on Monetary Policy from the Reserve Bank of Australia. Now, the board, they decided to leave the cash rate target unchanged at 3.60%.
Right. The hold itself wasn't maybe the biggest shock.
No, but the story behind the hold, that's the key. It's the caution. The RBA sources, they really paint a clear picture. They're now acknowledging more persistent inflation in the economy than they were expecting just a few months back.
And what's fascinating, I think, is just how big that surprise was. The RBA had, they'd sort of convinced themselves, and maybe the market too, that inflation was on this predictable path back to target.
A glide path, they hope.
Exactly. And now they're admitting, pretty frankly, actually, that they might have misjudged the underlying domestic heat. And that misjudgment, it fundamentally changes their whole forecast timeline.
Okay, let's jump right into that surprise then. Starting with the raw numbers. We need to look at both the headline figure and that, persistent core. Let's start with headline inflation.
Okay, so headline inflation, it increased to 3.2% in year-ended terms in the September quarter. Now, just to put that in perspective, the RBA's own expectation back in August, it was only 2.5%.
Wow, it's a 70 basis point difference. That's a big miss in forecasting terms.
It's huge, and it was driven by things like the partial unwinding of those household electricity rebates, plus the usual suspects, volatile fuel prices bumping things around.
Right, and we can often sort of forgive the headline number a bit because of those volatile items, but what really dictates policy is that underlying trend. So what happened with the trimmed mean?
Ah, yes, the trimmed mean. That's the critical measure.
Yeah.
For you listening, if you don't spend your days reading RBA papers, the trimmed mean is basically the RBA's way of finding let's call it the genuine heartbeat of inflation.
How do they do that?
Well, they essentially throw out the biggest price shocks each quarter, the extreme outliers, like big fuel surges or, say, massive drops in vegetable prices, just to see what prices are doing in that stubborn middle ground.
And that heartbeat? It sped up quite a bit, didn't it?
It certainly did. Underlying inflation, it picked up to 1.0% just in quarterly terms. That brought the year-ended rate right up to 3.0%.
Which is the very top of the target band.
Precisely. And remember, the August statement had expected that quarterly underlying figure to, remain steady at a rate consistent with the midpoint of the 2–3% range. Hitting the very top signals that underlying price momentum is, frankly, still too strong.
Okay, so if the core is heating up, where exactly is that pressure coming from domestically? We know the RBA is, hyper-focused on the bits they can actually influence.
Yeah, they really single out two key domestic hotspots. First one, new dwellings. We saw larger-than-expected price increases there.
Why is that?
It looks like builders are reducing discounts and increasing their base prices. This probably reflects, recovering demand and construction activity. They just don't feel the need to undercut each other quite so much anymore.
That's frustrating, isn't it? Because we've been waiting for those supply chain pressures to fully ease off, and now it sounds like builders are just, baking in a larger profit margin they might have discounted before.
That seems to be part of it. And the second major area is market services. So we're talking about the services people consume pretty frequently. Think restaurant meals, takeaway, fast food.
Stuff people feel directly.
Absolutely. And higher prices here reflect rising wages and other input costs so that businesses are, passing directly onto consumers. These sticky domestic costs, they're the hardest ones to shake loose.
Because they require demand itself to weaken significantly.
Exactly. And that takes us straight to the RBA's other big headache, the capacity dilemma.
Right. So the prices are high because people are still spending on services, maybe still building homes. But why is the economy letting those prices get pushed higher? That capacity dilemma means the RBA concluded the recent data suggests, and this is their quote, a little more capacity pressure in the economy than previously assessed back in August.
Yeah, to simplify capacity pressure, maybe think of the economy like a highway. Capacity is the speed limit, right? If you have too many cars, that's demand trying to go faster than the speed limit, that's capacity. You get gridlock.
And in economics, that gridlock is inflation.
Precisely. The RBA is basically realizing the speed limit might be lower, or perhaps the number of cars is higher than they thought just a few months ago.
And this is so crucial because if the economy has more excess demand than we thought, then inflation is just going to stick around for longer. It's almost guaranteed.
That's the worry.
But the labor market, which, should be cooling off by now with rates this high, it seems to be offering some mixed signals. That makes assessing this whole capacity thing really tricky, doesn't it?
It certainly does. On one hand, we saw what looked like easing indicators. The unemployment rate, it picked up a bit more than expected, averaging 4.3% in the September quarter, even hitting 4.5% in the month of September itself. And employment growth slowed down too.
So if you just looked at that headline unemployment figure, you might think, okay, maybe the RBA can breathe a little easier.
You might think that, but the RBA, reading between the lines of the statement, seems more focused on the underlying tightness indicators. They seem to believe those outweigh the headline cooling.
Okay, so what are those underlying signals that convince them the economy is still running too hot despite that higher unemployment number?
Well, it's the nuance beneath those headlines. We still have a pretty low underemployment rate that was 5.9% in September. People wanting more hours still can't necessarily get them easily, but the number wanting them isn't huge. More importantly, perhaps the ratio of vacancies to unemployed workers. It remains elevated. Firms are still finding it hard to fill roles easily. That's a classic sign of a supply-demand mismatch in labor.
I thought the unit labor cost, the ULC's data, was particularly compelling here as well, because that's the key metric linking wages directly to prices, right?
It absolutely is. And high growth in ULCs, well, they increased 5.0% over the year to the June quarter. That 5% rise isn't just an expense for businesses, it's really the core transmission mechanism for future inflation.
Oh, so.
Well, when businesses see their cost per unit of output rise by 5%, they almost have to raise prices eventually to maintain their margins. That just guarantees future inflationary pressure baked into the system.
And the sources also mentioned the quits rate picking up recently. Now, for you listening, the quits rate is just the share of workers who are voluntarily leaving their jobs. Why is that signal so important right now?
It's about confidence. When people feel secure enough to voluntarily quit, maybe without another job instantly lined up, it signals there are plenty of new opportunities out there. It shows high worker confidence.
Which means firms have to compete harder.
Exactly. It indicates increased inter-firm competition for staff, a textbook sign of an economy running a bit too hot, forcing businesses to bid up wages to attract or retain people.
And this capacity pressure isn't just about people either. The NAB measure of capacity utilization, basically, how hard businesses are running their equipment and factories, that picked up too, and it remains above its historical average.
Yeah, so if we connect all these dots, the bigger picture implies the economy was, well, somewhat further from balance back in August than the RBA thought at the time.
Meaning the existing high cash rate needed more time to work.
More time to reduce demand and ease those capacity pressures than they originally modeled. They basically misjudged the starting point.
Okay, so this revised view on persistent domestic tightness, it didn't just surprise the RBA, it clearly shook up the financial markets too, both globally and here at home. Let's move on to financial conditions. We saw a pretty dramatic reset in expectations for the Australian cash rate since that August statement.
We certainly did. The path for the cash rate that the market expects has shifted significantly higher. We're talking around 30 basis points higher than what was anticipated back in August.
And what about rate cuts?
Well, critically, market participants are now assigning only a very, very low probability to a rate cut happening in 2025 at all. Looking further out, only one single 25 basis point cut is priced in by the middle of 2026.
So the market basically believes easing is off the table for a long time.
That seems to be the broad sentiment reflected in pricing, yes. Indefinitely might be too strong, but certainly for the foreseeable future.
And that sentiment, it really stands in stark contrast globally, doesn't it? This is where we see that policy divergence really clearly. While the RBA is holding tight because inflation is persistent here,
other major central banks were already easing. That's the key difference. You had the U.S. Federal Reserve with cumulative cuts of 50 basis points across September and October. They were citing increased downside risks to their labor market.
and not just the Fed.
No, the RBNZ in New Zealand and the Bank of Canada also eased significantly around that time. And their reasoning was similar, weakening domestic outlooks, softening labor markets.
So the RBA is standing somewhat alone here, with a rationale driven much more strongly by this entrenched domestic inflation, particularly in those sticky areas like housing and services, whereas their peers seem more worried about potential recessionary forces.
That's a fair summary. Although we should note, financial conditions domestically have eased slightly because of the RBA's earlier cuts. Things like variable mortgage rates are down maybe 75 to 80 basis points since January.
But the pain is still there for households.
Oh, absolutely. Scheduled mortgage payments remain extremely elevated. They were at 9.8% of household disposable income in the September quarter. That 9.8% figure is the constant, painful reminder to the RBA that monetary policy is indeed biting, even if inflation isn't reacting as fast as they'd like.
Okay, so if demand and capacity pressures are stronger than expected, that must mean the outlook for actually getting inflation back to target has been delayed. What's the critical timeline shift the RBA has had to concede now?
Yeah, the timeline has definitely stretched out significantly. Underlying inflation is now expected to remain above that 2-3% target range until the second half of 2026.
Second half of 2026. Previously, they were hoping to hit that target much sooner, weren't they?
Much sooner. And furthermore, headline inflation is expected to stay above 3% for most of 2026 as well. The central forecast only really expects underlying inflation to settle a little above the midpoint of the target range by the end of 2027.
Wow, end of 2027. And the housing market seems to be a big part of why they've had to push that forecast out. Prices have increased, as you said, more quickly than expected, and that supports the revised outlook for household consumption and dwelling investment.
It does, and this is potentially compounded by policy factors, too. The RBA's statement specifically notes the Australian government's 5% deposit scheme coming into effect on October 1st, 2025.
Right, the scheme allowing first home buyers to purchase with only a 5% deposit.
Exactly. And the RBA's judgment, stated pretty clearly, is that this scheme is likely to put further upward pressure on housing credit and prices.
Which is a classic example of conflicting policy signals, isn't it? The RBA is trying to dampen demand, while fiscal policy in this case is providing stimulus directly into the housing market.
It certainly creates a challenging environment for the RBA. Now, overall, they judge the risks around the inflation outlook to be balanced, but importantly, they acknowledge the high uncertainty in actually assessing spare capacity.
They're basically admitting they might have got it wrong.
They're admitting the possibility they misjudged the degree of excess demand in the economy, which, for a central bank, is a significant admission.
Okay, let's just bring this all back together then. The key drivers for the RBA's decision to hold the cash rate at 3.60%, despite maybe wanting to ease off, it seems twofold. First, that unexpectedly strong and crucially persistent nature of underlying inflation, especially in new dwellings and market services.
That stickiness, yes.
And second, the revised assessment that the Australian economy just has slightly more capacity pressure, meaning demand is still running slightly ahead of supply than they previously estimated back in August.
Yep. It's really the realization that getting back to that 2-3% target is going to be a longer, slower grind than they had perhaps modeled or hoped for even just a few short months ago.
And this whole discussion, it really hinges on that idea of the output gap and capacity pressures. The difference between how fast the economy can be running, its potential speed limit, and how fast it is actually running. Which leaves us with a bit of a provocative final thought for you to consider. The RBA had actually relatively quietly lowered its assessment of medium-term trend labor productivity growth earlier in the year.
Yes. That underlying assumption is, well, it's everything, isn't it? If the sustainable speed limit of the economy, its potential output is fundamentally lower because productivity growth is slower than we used to think.
Then even if GDP growth stabilizes around, say, a relatively sluggish 2.0%,
the economy is inherently tighter than we would have assumed maybe 5 or 10 years ago for that same growth rate. That quiet downward adjustment in the potential growth assumption, it fundamentally changes how tight the economy is perceived to be, and it's a massive uncertainty that will, I think, continue to shape monetary policy discussions well into 2026 and 2027.
a fundamental shift hidden beneath the surface. Lots to think about there.